Hey everybody, back with another ETF review, and today we're actually going to be looking at two ETFs as opposed to the usual one because they are very similar and are sister funds. We will be looking at AOK, which is the Ishares Core Conservative Allocation ETF, as well as AOM, which is the Ishares Core Moderate Allocation ETF. I'm doing these because I've been seeing and getting a lot of questions from people asking about how they should allocate their portfolio. Should I be buying bonds right now? Should I be all in the S&P 500? Should I only be partly in the S&P 500? Should I be in something else? And these funds kind of answer that question by themselves. They are essentially entire portfolio funds. They are ETFs made up of other ETFs that take the picking and choosing of where you should put your money out of the equation for you. It does that for you themselves. Before we start, I do want to say that the names are slightly misleading. If I were in charge of naming iShares funds, the core moderate allocation would be the conservative allocation, while the conservative allocation would be the ultra conservative allocation. Both of these funds hold more bonds than they do equities significantly, and when you do that, you are in the conservative range. There's nothing really moderate about the moderate fund, and the conservative fund is very conservative. For something to be moderate, you would be thinking about a balanced fund at a 50-50 split, or the traditional 60-40 split between stocks and bonds. These, however, are far more bond favored, so keep that in mind if you're looking at these and thinking that they're more of balanced funds. They are not. As usual, we'll start by looking at our expense ratios, and here we can see it is currently sitting at 0.25% for the conservative allocation fund, which is the same for the moderate allocation fund. However, do note that in 2026 they will go up to 0.31 and 0.3% respectively because the fee waivers end. Not a huge deal, not a massive jump, but just be cautious of that. Be aware that your expense ratio will go up in the next 5 years. Now, overall for the expense ratios, very average. They're either the low of the average side or the high of the low side. Nowhere near the ultra low expense funds where you're at 0.06%, but also nowhere near active funds which can range up to 2% for the average. These are very average expense ratios for passively managed funds, which these are. So don't worry about that. Another thing to note is that the holdings of these funds are the same. They are the exact same holdings, but the allocations inside the funds are different. We'll start with the conservative allocation ETF. It holds total bonds, the S&P 500, international bonds, international developed equities, emerging market equities, mid-cap and small-cap funds in the U.S., as well as a money market fund. This is exactly the same for the moderate allocation ETF. The only thing that's different is the allocations, with the conservative allocation having about 70% in bonds and about 30% in equities, while it is 60-40 bond stock for the moderate allocation. So just know that these are very heavily favored towards bonds. If that's not something you're interested in, this isn't going to be for you. Don't worry about that. But if you are looking for something that is more bond favored, or if you're looking for something that is traditionally a safer quote-unquote investment, might be something for you. But we'll go back into that more later towards the end of the video. After that, we can take a peek at the returns and see what they've both been doing. For the conservative ETF, we can see that since inception we're getting about 6%, which is nothing to write home about, and over the last year we've done about 11.5%, while the S&P has done about 50% over the last year, if I remember correctly. If we go over to the moderate allocation ETF, we can see that it's slightly higher for since inception, about 7%, while for the 1 year about 15%. One thing to note with these is you're always going to trail the market in terms of gains, just because bonds will trail stocks generally over long periods of time. That's just the way it is. However, even though you were highly allocated to bonds with both of these funds, you still did better than the average for the S&P for both of them, doing well over 10%. So keep that in mind. Another thing to look at is the yields for these funds. They are not particularly amazing. With both, they are at about 1.5%, 1.6%. Nothing to write home about. If you are looking for dividends, if you're looking for income, these aren't really going to be much for you. It's very average. They're doing about what the S&P is doing. So if you are a dividend or an income investor, this is not something to look at, I can say wholeheartedly. So why would you look at this fund? What does it do? Why would someone invest in this? This essentially gives you wide exposure to as many parts of the global market as you can with only a single fund. You have US equities and US bonds, international equities and international bonds, all in a single ETF. It's done for you. You don't have to pick out the funds. You don't have to pick out the allocations. It's done and dusted. Nothing to worry about. You have it done for you. That's the big reason, the big draw of funds like these. However, there are risks associated with things like this. Particularly the high bond allocation. We are currently in a zero interest rate environment, which means interest rates only have one place to go, and that is up. While that will drive up the yield on your bonds, it will drive down the prices, and since this is so heavily invested in bonds, it should drive down the price of the fund when interest rates go up. So keep that in mind. You aren't, the cushion that you would typically have if there was an economic downturn is gone because the interest rates cannot be lowered and bond prices cannot then go up because of that. So keep that in mind. There are risks associated with this. The traditional risk management that this would provide is kind of messed up with the current environment. But let's go and test these funds compared to the wide market and see how we really would have done over time. We'll start with both of our funds, AOK and AOM, as well as VOO, the Vanguard S&P 500, as our control. If you had started investing in 2011, over the last roughly 10 years, you would have lost out to the market quite heavily, whereas the market would have returned about 430% or 330%. With this, you would have only made about 70 to 90% of your money. That is quite the loss. However, you can see that the drawdowns for this were much less severe than they were for the market. So if peace of mind, if volatility is something that you're concerned about, these could help you in those regards, given past performance, which is not indicative of future results. However, let's look at it over the short term. If you had invested in these as opposed to the S&P 500 by itself over the last couple years, if you were someone like me who didn't get started investing 10 years ago or 20 years ago and you just started, these would have protected you in those drawdowns. You would have done less than half of the drawdown of the S&P and would have slightly overtaken the S&P 500 during the worst of 2020. If you're one of those people who times the market, you could have had your money in here, had a very small drawdown, and then reallocated to the S&P and just done as well as everyone else, because as we can see, since that drawdown hasn't done nearly as well. So, who are these funds for? Who should be looking at them? Are they for you? There are three segments of investors, three groups that would benefit from these funds possibly. The first and most obvious would be people who are retired but still want to participate in the equities market, in the somewhat of a growth market, don't want to be just bonds. Something like this is still going to give you some growth. As we can see, even if you were just invested in these, you would have done better than 10% over the last year. You still would have gotten some growth without having to be as ridiculously 100% exposed to equities as other people. The other people that might benefit from this are people who are currently very scared of the market and it being in its current valuations. If you're someone who's racking their brain every night thinking there's going to be a crash, there's going to be a crash, there's going to be a crash, but you still want to have money inside the markets, this could be something for you. If the markets continue to go up, you're still going to get returns here. If the markets do draw down, these should draw down less, and that should help you with that peace of mind issue if you're the average person. The last group of people, and I will get a lot of blowback for this, but I really don't care, is this could be very useful for your average investor or someone just starting out investing. The reason I say that is that if you have, for example, $100,000 to invest, but you don't want to put $100,000 in the S&P 500, you might think, you know, I'm a little hesitant about putting all this money in. What if something happens? You could take something like 25 or 40 or 60 or 75% of your money or whatever number and put it in something like this, and then put the rest into your growth fund, your S&P 500, your Russell 2000, your QQQ, whatever. Whereas you have something, this is your core position that does, it might do worse, but it's going to give you that peace of mind. You can still use the rest of your money to get into those riskier or wide market investments. A few things to remember is that this is not going to be for everyone. Just like every fund, do your research. If you have certain things are holding you back about investing in the S&P 500 or the NASDAQ or the Dow or whatever market, but you still want to be invested in the markets, don't listen to the people saying, oh, you should just be 100% in equities, you're going to get long-term. If that's not who you are, don't listen to those things. Don't just take my word for it because I'm a YouTuber. Don't take their word for it because they're a YouTuber. Do your research. If something fits your time horizon, your risk assessment, go with whatever works for you. Go with what helps you sleep at night. Don't lose sleep over your investments. If something like a moderate, quote unquote, or a conservative allocation is going to make you sleep better at night, if it's going to help you in your life, do that. If the 100% of your funds in SPY is going to help you, do that. Just do what works for you. Do the research. If something like this is good for you, then that's great. If not, that's fine too. I hope this helps, and thanks for watching.